Now here's the deal with moving averages. They have limitations. They're very useful, but they're not perfect. You know, nothing's perfect, right? But they can be used really in conjunction with other types of indicators as well, as far as a really good confirming type indicator or working as a pair. And some of these challenges, though, are harder to overcome than others. So let's take a moment to talk about some of the limitations of this. They're good, but let's talk about some of the limitations and some of the ways that we can overcome them. We talked a little bit about filters with the simple moving average. Let's talk about some other things we can look at as well. Now, one of the limitations of moving averages in general is when markets go sideways, right? There, you can almost see from the image there in the circle where it goes up and it goes down, up and down, up and down, and it's kind of going the sideways thing versus a definite upward trend or a definite downward trend. Moving averages are better that way. They struggle a little bit more when there's no trending or they're moving sideways. It makes it harder to predict the next move, and that's where our whipsaws come in, right? They're frequent price changes above and below the crossover line, giving us different, buy and sell signals constantly, so we might be, forced to trade more often unless we filter that. The value in a sideways movement is you can recognize that is to recognize that it's occurring and then adjust or wait for a trend to appear, or you can use other tools with the moving average to identify actions to take, like looking at support, resistance levels, different things of that nature. But understand that a moving average can be a little bit more limited in a more sideways market. If we look at this image here, you can see where there's a definite uptrend in the blue and a definite downtrend in the right. And then we see the sideways trend there in the middle where it kind of is bordered between the two, the top and the bottom on that. And then, using things like our chart analysis, we can identify that it's a channel and we can sell near the tops of this channel, for example, or we could buy near the bottoms of the channel. This is our resistance and support lines that you see that we've driven over the top of it above these prices. And then if we look at the moving average overlaid on top of that, maybe we could also look at, to be even more comfortable, we could say, well, we're going to sell near the top of the channel, expecting it to come back down. And then when it comes back down, maybe we've sold at the top of the channel, but if we're not sure of the channel, we would certainly sell after it crosses that moving average line. And then as it gets more near the bottom of that support level, then we might buy near that bottom as opposed to buying, or we could wait until we bought, after it crossed the line again. So you can kind of see where, they can kind of work together, these different channels and moving averages. And there's different times when you'd be buying or selling, whether you're moving quicker on something like that or slower on something like that, depending on the channel and depending on the moving average. Another limitation dealing with moving averages is noise, right? If you have a disorderly chart, there's lots of outliers, right? So it's kind of noisy. You have real spikes or you have high prices, low prices. It doesn't seem to be really, very organized as far as a chart or a noisy chart. It can give off more false buy and sell signals, right? It's going above and below the line, whipsawing a lot. It just seems to be all over the place. And you can fix that by applying a moving average with more days in it. So things that are these big outliers can get smoothed out more and become less of an outlier, because a longer time frame will actually smooth that out more than a shorter time frame. However, a longer time frame will increase the lag a little bit more. It doesn't put as much emphasis on more recent prices. So it's with all these things, you have kind of a give and take around that too. But if you're dealing with a chart that seems just real confusing, highs, lows, all over the place, and you want to try to get a feel for that moving average, try a longer time frame to give you a little bit another way of looking at it, understanding though that it might increase the lag. And then if we look at lag itself, that can, of course, is a limitation. And you could see a dramatic price move, and you could see potential profits. Like, look at where it went. It went way down. There might be a way to buy in, and then there might be a good opportunity here. But you're, let's say you're a disciplined investor. Hopefully you are a disciplined investor, and you decide you want to wait a few days for that lagging moving average to catch up and then actually create the crossover. So you can see it kind of happening. You see it kind of moving towards the line, the moving average line, but you're waiting for the crossover to happen, which is your way of confirming and your way of making that decision around that. And if you put an extra filter on, like it needs to cross the line by, like, say 2% or 3% before you actually make a decision, let's say to buy, for example. Meanwhile, while you're waiting for that kind of lag, you could be losing out on profits waiting for that to happen. Now, the nice thing with technical analysis, you don't have to be perfect. You don't have to be perfect every time. But understand there's an opportunity cost, where you might be delaying to avoid the whipsaw and avoid frequent trading, but you're experiencing that lag. Now, you can fix that by applying a moving average with less days in it. So it'll be more sensitive to that recent price, or you put maybe more of a weighted moving average with less days, then it's doubly sensitive to a more recent price, and so you're trying to reduce that lag a little bit as far as your trading decisions go. But if we look at some of those things, you can see the conflict. I hope you saw the conflict there right away. If not, let's talk about that. You have noise and lag, right? And noise you fix by applying a moving average with more days in it, and then lag you fix by applying a moving average with less days in it. So you kind of have to play around it, especially as you learn certain securities, what might work best for that particular security. But you can see there's a yin and yang here. You're by giving up one, you're getting more of another. So unfortunately, there's no magic number of days, right? I wish there was a magic number. I would say, well, the best number to reduce noise and lag at the same time is this number of days or number of periods, depending on could be hours or minutes, let's say, if you're a day trader. So there is no actual, perfect one. Some are, might work better than others, but there's no perfect one. You just have to adjust and understand, noise and lag. Alternatively, what you could do is just focus on a security that's more orderly, or in effect less noisy, has less of these outliers and things, so it's a little bit more orderly. So if you have less noise, you can kind of work on that lag part a little bit more and use a moving average with less days because the security is moving in a more orderly fashion. So that's another way you could do it. And then there's another option which you could use multiple moving averages as a strategy. And we're going to talk about that next here. And so we're going to talk about that strategy where you're not looking at when the price crosses over and dealing with that limitations. You're going to look at when moving averages cross over each other. So let's take a look at that here in the next lesson.